Preferred stock valuation. By definition, preferred stock is a series of stock that's issued by a corporation that has characteristics that make it a little bit different from common stock. In fact, it's sometimes referred to as a hybrid security because it has characteristics similar to common stock, but it also has some characteristics that remind you of bonds as well. One of the first things to note about preferred stock is that preferred shareholders generally get money in the form of dividend distributions and in the form of liquidation in the event of a company going bankrupt ahead of the common stockholders. So preferred stockholders get theirs first. That's one of the first things that we need to note here. The other thing that's worthy of note is that preferred shareholders generally do not have any voting rights. So although they're first in line to get their money, they are not among those who control the corporation by voting for board of directors. Those rights are usually reserved for the common shareholders. Now, dividends are not required by law to be paid by a company, but most companies that pay dividends to preferred shareholders treat those dividend payments as if they were an obligation. Technically, they are not. They're not required to pay preferred shareholder dividends, but in many companies, especially companies that are in fairly decent health, they try to make that preferred shareholder dividend payment as consistently as possible. And that's one of the reasons that some people say that preferred shares are sort of similar to bonds, because the payments that you receive are so consistent it almost seems as though the company has an obligation, even though it really doesn't. Some issues of preferred stock can actually be pulled off the market or retired by the issuing company. In other words, they can buy those from you and not have to pay you those dividends anymore. And in some cases, preferred stock is actually even rated in a fashion similar to bonds. So this really is a hybrid security. It's technically a stock, has some behaviors that remind us of a bond. And one of the things to note about preferred shares is that usually the dividends remain the same. Obviously, there's nothing legally that says that has to be the case, but in most instances, preferred stock dividends remain the same year over year over year. Therefore, we usually refer to these as no-growth instruments. In other words, it's just going to pay you the same amount of money every year, and that's not going to change. To figure out how much a share of preferred stock is worth, we can refer to a model called the preferred stock valuation model, sometimes known as the no-growth model. No growth meaning the dividends just probably going to remain as is. This is very simple. We would say that the price is equal to the dividend divided by the required rate of return. So in other words, what's the dividend that's being paid on these preferred shares? And what is the required rate of return that's demanded by the shareholders? And that leads us to the share price. In this example, we have a $1 dividend. We have a 5% required rate of return from the investors, and that leads us to a share price of $20 per share. Very simple model. It attempts to explain the dynamics behind valuation of preferred stocks. Nothing terribly sophisticated about it, but it does capture sort of the essence of the moving parts, as if you will, that are involved in calculating that price.